I was listening to a podcast the other day. I think it was 20-minute VC, and Jason Lemkin was touching on like the idea that basically when you back a founder in one space, you can't back their competitors because like people will they have like a visceral reaction. Like, you believed in me and now you're doubling down on somebody else who's my direct competitor. Like, it's antithetical to like the blood, sweat, and tears that I'm putting in here. And a lot of these funds say like, oh, we are founder friendly, but it sounds like a lot of that's going out the window, and they're prioritizing like, this is a can't miss, because like my downside is I lose 1x, but what happens if I miss out with like an OpenAI or Anthropic and my upside was 100x?
100%. So I wrote a piece a couple months ago called "The Horse, the Jockey, or the Whole Race." And it was basically based on a conversation that I had with Eric Newcomer about a tweet that I had tweeted where there's this anonymous account that is amazing. If you're not following him, you should follow him. Endowment Eddie. He's awesome. And he tweeted and basically said like, okay, wait, so is investing in competitors like on the table now for VCs? And I posted a picture that I like very roughly made super quickly. But it's like Andreessen is invested in OpenAI, Thinking Machines, which is one of their former co-founders' new company, Thinking Machines, xAI, Mistral AI, and Safe Superintelligence. And so it's like there's 5 companies right there that are basically all largely competing, chasing the same thing. A number of companies that are invested in OpenAI and Anthropic, xAI and Anthropic and OpenAI. Like it's very incestuous when you have the largest firms and the largest AI companies. It's super incestuous. If you looked at the same chart, the like Uber versus Lyft battle years ago, there was actually a lot of like overlap where like there was sort of some obfuscation and people would try to invest in things and then later invest in other stuff and whatever. Or they had invested in other non-Uber versus Lyft, but like Zipcar or whatever, and then invested in Uber because it became the winner. That was like a baby version. AI is like that times 10 on steroids. Like it's insane. And the reason for that, when you look at most of these firms, and there are definitely exceptions to that. There's a few firms, folks like Thrive and I think Founders Fund, who have been monogamous. So there are a few firms that have like a few big firms that have kind of committed to that. Hey, we're going to invest in one company. But if I'm Andreessen, it's like, well, why would I invest in multiple companies that are largely chasing the same thing? And the reason for that is because it no longer matters this like founder friendliness. Andreessen has so much capital, so much power, so much halo effect. It has become this black hole of influence that you can't ignore Andreessen. Even if you don't like them and they make you grumpy, like it's really hard to ignore them because they're so powerful. And so because of that, they are able to go invest in multiple companies that are largely chasing the same thing. And maybe they justify it because they say, oh, like OpenAI is really focused on consumer AI applications and Thinking Machines is more focused on these like, I don't know, like, or like Safe Superintelligence is focused on a very specific kind of like model development or whatever, like, you know, who knows? Whatever the justification is, like it's lip service, right? It's like these are all companies who are largely chasing super intelligence, whatever that means. They're doing it through, we need to build the highest quality models and deploy them in the use cases that will get the highest volume usage. And by doing that, we will get the volume of data and the volume of feedback and the ability to learn. They're all chasing the same thing. And if you're Andreessen or, you know, Sequoia or Lightspeed or whoever that are investing in multiple companies, your thesis is, listen, we have to deploy $2 billion or whatever our latest fund is. In order to justify the existence of a $2 billion fund, if OpenAI becomes the one breakout, you know, and it already is like whatever, $200 billion outcome, but if it becomes the like $1 trillion outcome, you cannot miss that winner. If you're deploying $2 billion, that means like you have to be in the winners.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, lol. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.